So many people come and tell me that, hey, listen, I realized I had a profit, X amount of profit at November, almost December, so I didn't want to pay any taxes, so I bought a bunch of inventory. That's great that you bought a bunch of inventory. I love the reinvestment, but that's not an expense. You can't deduct inventory until you sell it.
Hey guys, welcome back to the Zoncom podcast. This is Andrew Erickson, your host as always. Today I'm very excited. We are bringing you a hot topic because it is the end of March and early April right now, and we are talking about taxes because as most of you guys know, corporate taxes are due in March and personal are due in April. So I figured let's talk about taxes. We're going to talk about some the best, kind of the biggest mistakes that people do on a day-to-day basis running their business, and also in the next episode, we're going to talk about some kind of big money stuff. When you're past the day-to-day and you start talking about exiting and other ways to kind of like special ways to move money and wealth around, avoid or not avoid, optimize our taxes. We're going to talk about that. And today I got the CEO of Avask on the call. Tim Nelson is here. He has been a CPA, an official, a certified accountant for the last 7 years. And he actually literally wrote the book on sales tax accounting for e-commerce sellers. So he also sells that book on Amazon. So he himself is technically an Amazon seller. So Tim, thank you so much for being here. Excited to have you.
Thanks, Andrew. I appreciate it.
Nice. And then Tim, why don't you tell us a little bit about Avask? You said you're the CEO of the US version of Avask. Why don't you tell us what is Avask, and then maybe tell us a little bit more about yourself as well.
Sure. Avask is a global e-commerce accounting firm. Our headquarters is actually in Southampton, the UK, and we have offices in France, Germany, Italy, China, and the United States. So what we do is we actually handle or help sellers who are looking to sell in any of the e-commerce markets throughout the world get set up and make sure that we take care of their taxes and make sure that they're compliant so that they can just focus on selling. Myself, I've been helping sellers like yours, part of the Titan Network, for maybe the past 7 years, dealing with all the different laws and tax changes that have happened over these past few years regarding either sales tax, corporate taxes, or even most importantly, helping them plan their personal taxes to try to save them money, as you were saying before, or as we say, try to help them pay the right amount of tax, try to optimize things so that they're happy with the amount of money they get to keep in their pocket.
Nice. Love it. Yeah, pay the right amount of tax. That's a good way of saying it.
Thank you.
What's the phrase? Tax evasion. Tax evasion is illegal. Tax avoidance is preferred.
Yes, we call it the gray area. So as long as we're kind of living in that gray area of is this right, or are we allowed to do it? That's something. Exactly what we try to do, and hopefully it saves our taxpayers some money.
Tax evasion is illegal. Tax avoidance is
preferable.
Preferable, yeah.
Yeah, cool. There we go.
Awesome, great. So I wanted to ask you a few of the day-to-day things that I've had issues with in my business, and I talked to a lot of other Amazon sellers and e-commerce sellers and some of the things that they've had issues with. So I guess the first one I'd like to ask you about is can you walk us through a little bit of the advice on how we should structure our companies? If we're kind of at the very beginning and sort of just trying this thing out, and then we start getting up to the point where we're doing some good money, and then we get to the point where we're thinking of building, we kind of have this multi-million-dollar corporation. How should I structure it? LLC, S Corp, solopreneur thing? How do I do that?
Sure. And it's a question that actually comes up quite a bit. And I find that a lot of sellers, no matter what platform they're selling on, kind of Google it or ask their friends what they're doing, and then just form the entity on what somebody else is doing, whether it be an LLC, an S corporation, a C corporation, or sole proprietorship. And actually setting up the right entity right from the beginning is actually rather important. There are benefits for each type of entity, and just knowing those simple benefits, I think, actually helps you, the seller, decide, okay, hey, I want to go in this direction, so that it helps me in the end because I can understand why I'm this type of entity. The first type of entity that actually nobody should ever choose, is a C corporation. And most people are not, because it's the only entity where you could be subject to double taxation, meaning the company makes money, the company pays tax on that money. But then let's say you, Andrew, as the owner, want to take money out of that corporation, you have to pay tax again on your personal return. So you're paying tax on the corporate end, then on your personal end on that same money. So hence double taxation. So, and I rarely come across anyone who's formed that type of entity, but I figured let me just get that one out of the way. Usually, foreign sellers who try to sell into the United States have to choose that entity. That's the only time it ever comes up. But our U.S. sellers, people that are citizens here, rarely have to be that type of entity.
Well, so probably I think a third or half our audience are actually non-U.S. residents. So how should they do a C corp?
They would have to, actually. They could be a C corp
Really?
or an LLC. Foreign people are not allowed to be an S corporation by law, so they can't even choose to do that. So they can choose to be an LLC or a C corporation. Even when you choose to be an LLC, you can elect to be taxed as a C corporation. So yeah, there's usually two different things there for those individuals to choose from.
Can you be an LLC and be taxed as an S corp if you're a foreigner?
Not if you're a foreigner, only if you're a U.S. citizen. So anything that has to do with S corporation is only available to U.S. citizens.
Oh, did not know that. Good to know. So interesting. Okay, so if they're an LLC but not a C corp, would they just file as a sole prop?
They could file as a sole prop, or actually two owners of an LLC would file a partnership return by default. So then they would have to either file a partnership or the C corp.
What do you suggest? Let's say somebody is getting up to that $1 million a year in revenue, or let's say if they're beginning their company and they're forming it and they're based in the UK, selling primarily in the US, and they are wanting to get to $1 million in whatever 2 years, right? That would be kind of an income of $200,000.
Sure.
Should they form as a C corp?
And that is a loaded question. So I'm going to give you such a good answer because there's so many tax rules that come into play there. But really, they could. First of all, they don't even have to form an entity here to sell into the United States from the UK. So they could just get an EIN number and just register for sales tax in the proper spots and just start selling. And they're good. I mean, the most thing they may have to do is we'd file an informative return for them, because like many gray areas we were discussing before, the IRS really hasn't caught up to what selling through e-commerce is like. And so they don't even know if a company who sells, let's say, from UK into the US without forming an entity has to pay or file taxes here. So what we do is we file for them an informative or a protective return saying, hey, we're a company, we have no nexus because we don't have an office, we don't have any people here, but we're selling here, but we're not going to pay tax here. We're picking up the income because we're a UK company over in the UK. And that's where tax treaties come into effect and stuff like that. So hopefully I didn't dive too much into it, but you can structure it and still sell in the US without having to form any kind of entity. But then once exit strategies come into play, it might benefit to have a US company in case you want to just sell off the US side of things and not your UK company, as opposed to have everything under one roof.
Interesting. Good. Okay, good to know. So like everything here, it's complicated, but if we're talking about US residents, in general, you would want to be an S corp, right?
That would be my advice.
When are the times we would not want to be an S corp? Just so we can maybe we know when not to do it, we'll know when most of the times are.
So if you're not an S corp, you're going to be an LLC. Those are really the two choices. I would never advise anyone to be a sole proprietorship. Why? Because it's not giving you that corporate protection. An LLC and an S corp give you that corporate protection, meaning, God forbid anything ever happens, somebody sues somebody for what product, this, that, or the other thing, they only can sue you, the company. They can't sue you personally. So that protects your personal assets. So I would always tell anyone who's a sole proprietorship, all right, even if you've been a sole proprietorship this long, let's look at forming some kind of entity to protect you. All right, then it comes down to, all right, do you want to be the S corporation or the LLC? The LLC is the simplest type of entity to run. Basically, all your income and expenses are put through the LLC. It flows to your personal return and you pay your tax there. What you also pay is self-employment tax. That's the government's way of saying, hey, you didn't have to take payroll and no taxes came out of your paycheck. So we want to grab those taxes. Those same paycheck taxes that come out of your paycheck is what self-employment taxes are on your personal return. So you're paying tax on the income from the LLC plus self-employment tax. That's what it really means to be an LLC. An S corporation, which I would always recommend to everybody, does it a little differently because you have to first file an S corp tax return, which you won't owe any tax on. There's never federal tax on an S corporation. You may have to just pay whatever state you're registered in an S corp fee, which could be like $300 or $500, depending on your revenue. But just like an LLC, it flows to your personal return and you pay the tax there. But you don't pay self-employment tax, which is about 15%. So that's a 15% savings. If you have a profit of $100,000 or even $200,000, like you were saying, that could be $15,000 to $30,000 of tax savings.
Nice.
So everybody could be like, wow, why am I not an S corp? Let me make sure I throw on the other side of that coin. What is that? Again, self-employment tax that you'd be saving on. Well, that's the Medicare tax that comes out of your paycheck, but more importantly, your Social Security. And so everyone always thinks about, hey, when I retire, am I going to have, how much Social Security am I going to have? Well, if you're not paying in that self-employment tax, you're not contributing to Social Security. I'm 45 years old, not going to retire for a while. I don't think Social Security is going to be around that longer, but again, that's just my opinion. And so I present it to the seller when forming the entity. Here's what we can do. But there is a way around that, meaning, well, actually, let's step back for a sec. But the IRS says when you form an S corporation, since you're not paying self-employment tax, you're supposed to take payroll as an owner. How much payroll are you supposed to say? Oh, IRS is always crystal clear on that, a reasonable amount. Now, what's reasonable to me, you, or the other person can vary in any amount. But it's a rule that actually the IRS does not even enforce. So a lot of the S corporations that we do either have payroll and it's a very small amount, or just haven't gotten around to having to pay payroll at all. So they're getting that full savings. But let's say, Andrew, you're the person that I want to make sure I follow the rules. I want to make sure I take payroll. And you've got $200,000 of profit. Well, okay, we're going to put you on payroll for a reasonable amount. Let's put you on for $20,000. Now you're still saving that 15% on that other $180,000. So you're still taking the payroll like you did as the IRS would want you to do, but you're saving all that tax on that extra $180,000. So in my advice to all our clients, I find the benefits of an S corp to be there.
Nice. That's good. So let's just say 99% of the time S corps are good if you're a US resident and you're doing that kind of, you have like a, at least whatever jobs worth of income, right?
Right.
Great. Good to know. So we said I pay myself what was it? I think it's $3,000 or $4,000 a month in W-2.
Sure.
And what I reasoned was, an account manager would make $20 an hour, and 20 times 40 hours a week is $40K. And so I think $3K, whatever, $3 or $4K, whatever it is that we run through W-2. Am I paying too much? I cut that in half. You said 20 is cool.
Yeah. Well, again, what is the definition of reasonable amount? It depends on who you're talking to. That's why it's such a gray area. I think it's a reasonable amount. I mean, a lot of people can look at it, forget what kind of job I'm doing. What's it compared to the amount of income that the company's showing? It depends. Maybe it might depend.
I've heard other people say that you should take half of your income, half of your profit should be W-2. But you're saying that's way too much.
I don't read anywhere or anything that says you should take half. If I'm looking through the IRS, verbiage, there's nothing that says half. It's just reasonable. Well, again, has anyone ever come up and questioned you from IRS or state on the amount of payroll you're taking? The answer is no. In the 25 years that I've been an accountant, it's never come up once. Never been questioned. So let's just make sure, whether we want to take payroll at all, because it's a company that's not making money, let's say in its first year, well, reasonable amount of payroll is zero. I mean, we may be losing money right now because we're getting everything structured. So why register for payroll and start taking taxes when you're losing money? let things get going first, let the company make money, reinvest in inventory. You may want to put that money in a couple of other places to get the company up and going, and then maybe address payroll 2 or 3 years down the line. But
Nice.
still, you're at least saving on those taxes because, again, everything flows to your personal return, which, again, if losses, it lowers your taxes, lowers your income, and profits, okay, go to your personal return and you just pay it all there.
All right. You gave me some action here. I'm going to cut my salary in half. So good. Nice.
Yeah, I don't know if that's gonna. Yeah, exactly. I just out of this conversation, I just made you take home less money. But again, like it, just like an LLC, an S corp, you don't have to take money to get money out. You don't have to take it through payroll. You can take it through draw. You can just take money
Got
out
it.
anytime you want, put it back in, no problem. Just remember, when you take money out of an S corp, it's not a deduction. So you're going to still have the same amount of profit. Put some money aside for taxes.
Perfect. Good to know. So that's great. Thanks for clarifying that. So for most U.S. residents, we want an S corp, and for foreigners, probably don't want to be a U.S. corporation. And if you do, there are exit implications of not being a U.S. company. I know that when you are U.S. based, it is easier to sell your business. I've talked to a lot of people who've sold their businesses, and the ones that are happy who have set that up are happier, and the ones who haven't, a little bit harder, have a little bit harder time. Have you worked with people going through non-U.S. residents selling a U.S. based or U.S. I don't know, we call it, most of our revenue comes from the U.S. customers. Have you worked with people who've done that?
Sure. And you're right. It has helped where having that, let's call it U.S. branch company, where it's not part of, let's call it the U.K., for example. It's got its separate revenue, separate expenses. It's easier for an aggregator to analyze those numbers, and you can just sell off that brand. You don't have to break everything out. It makes aggregators a little nervous when trying to really know what the numbers are, because they're ones making the investment to make the purchase. The numbers are a lot cleaner when you just have everything on the U.S. side detailed out, especially with the tax return, to show that you've got your revenue, you've got your expenses. Yeah, it makes it easier. Now you don't even have to sell the UK company. Let's say you want to continue selling a couple other brands or something like that, or maybe you have other plans. It's good, just say, okay, I'm going to sell this part and move on. So yeah, it's happened a couple of times, not that often, but I've seen the benefits of it.
Well, if we're planning on selling the entire revenue stream, like the entire business, and the business is all U.S. based, but we're a foreigner, a non-U.S. resident, is it better to set up that CCorp and get double taxed so that you can so it's easier to sell 5 years from now when you actually go to sell?
It could be. I mean, if you're going to sell the whole company, then you're looking at, let's say, Amazon. You're just looking at all the numbers, all the SKUs, all the data, transactions, stuff like that. It would be easier. I think it's more of just branching off a little. I only want to sell this section or that, but
Got it.
It can hurt.
Nice. Good. Okay, good. The next question I was hoping you would help us with is like some of the other mistakes you've seen, kind of solopreneur, or, a lot of our listeners are solopreneurs, or they're solopreneur plus a handful of freelancers, or they have a team of half a dozen people. So they're kind of that sort of mom and pop shop still, right? What are some of the biggest mistakes that people like this are making?
Sure. Yep. Let me give you two just off the bat, and they're actually pretty important, only because I've come across them quite a few times, or contacted by sellers who were using someone else, and they get a letter from the IRS that just says they owe tax. Because a lot of times the IRS won't even explain to you why you owe tax. They're just like, we've noticed an error. Here's how much money you owe. And usually the reason for that is that sellers, through their bookkeeping, won't pick up the right amount of revenue, because traditional accountants or accounting says if money comes into your bank account, that's your sales. That's what was deposited in your account. So I'm going to pick up that revenue, less your expenses equals your income. Great. I'm going to file my return and send it to the IRS. The IRS gets a 1099-K from Amazon, and that really tells Amazon what your sales are for the year. But that 1099-K never matches what is deposited into your bank account. And a lot of people just don't realize that, or especially other accountants that haven't dealt with a lot of Amazon sellers. Why that is that Amazon will take out their fees first before sending you their money, so that what money hits your bank account is not your sales. It's not actually what you sold. It's after Amazon got their fees. So making sure that you record your revenue or your sales correctly along with the Amazon fees is so important to avoid dealing with the IRS in any way, because they can be quite a headache. And so making sure you're doing that bookkeeping and recording that revenue, I think, is maybe the most number one headache or mistake that a lot of sellers or solo entrepreneurs could make. The second thing is recording inventory. This actually might be universal a lot, where just tracking inventory, getting good inventory valuation is quite a headache. But in this specific example, it's that when you purchase inventory, you can't expense it all. I've had so many people come and tell me that, hey, listen, I realized I had a profit, X amount of profit at November, almost December, so I didn't want to pay any taxes, so I bought a bunch of inventory. That's great that you bought a bunch of inventory. I love the reinvestment, but that's not an expense. You can't deduct inventory until you sell it.
I thought the new Trump tax thing from 2 years ago said that we can depreciate, we can deduct any like short-term inventory, which is like considered any inventory under 12 months.
It's so funny you say that. It's because I've read the same rule and it wasn't too clear. And I actually now will be taking on this client starting next week that is had now to go back and readjust their taxes because it's just not clear. They were deducting all their inventory. They got a letter from the IRS, and now they've got to correct it all going back. So I don't think that is correct, and it wasn't too clear. So we have all our sellers make sure we capitalize inventory and deduct it when it comes through.
Oh, that sucks.
Yeah, listen. That's what this person did, and again, it wasn't. I didn't think it was too clear on our end, so we were just like, we'll play it safe. Let's just go with this rule. So it's interesting that you just brought that up because we were just dealing with it.
That was a big thing that we were kind of like keeping that as an ace up our sleeve because we were hoping, when we needed to, we were going to switch if we have a big tax bill, we were going to switch from like kind of the inventory accrual basis to the inventory cash basis, or still accrual, like proper accrual, but then deduct the short-term inventory. That was my like, I'm waiting to do that. I'm holding that ace up my sleeve to get ready to like play it whenever I need to. But you're saying that the ace is probably fictional.
Yeah. Again, there was a lot of gray area on that, and nobody not really knowing 100% sure if that was right. But this one client having to make this one adjustment because of the IRS is telling me IRS isn't even sure, or maybe they're just cracking down on this one, because depending on which way you do it, that has a lot of effect on your profit and loss statement. You can either show very minimal profit, and then when you switch back to the accrual, you're not going to have a lot of deductions in 1 year and show a huge profit. So because you haven't been accumulating your inventory, you've been expensing it this whole time, and then now once you start accumulating inventory, you won't have any cost of goods sold. There's so many different ways of looking at that, but just from our point of view on how we've been doing it, yes, just capitalize your inventory, expense it when you sell it.
For growth purposes, I found it a lot easier to get as many deductions as early as possible.
Correct.
Because for us, like, man, I always tell people the most expensive thing that can happen to you is to be successful, right?
Yeah, absolutely.
You buy, let's say you're starting out, you buy $10,000 worth of inventory and you think it's like 4 months worth of inventory, right? But you sell it in 3 weeks, boom, and you double your money. Like, yes, oh my God, it took 10,000, turned it into 20,000 in 3 weeks. Production time plus 3 weeks of selling. Like, that's amazing.
Yeah,
like, heck right. Yeah, like, let's keep doing that. We can make 10,000 every 3 weeks. That's a really nice income for that's about 200,000 annual income. That's like, good. Let's keep doing it. Yeah, you got it. Right.
Yep.
Okay, great. Well, I spent $10,000. I now have 20 in my pocket. And then when I go to buy more inventory, well, I need to buy 4 or 5 months inventory to make sense. Right. Especially like maybe our sales are going to be even higher because we have more reviews and stuff. Right. Well, wait a minute. 3 weeks was 10,000. If we went 4 months, we need 5-10 times as much inventory. Right.
Correct.
So let's say what 3 goes, whatever. I always say don't do public math. So let's just say 5.
A lot.
A lot. 5x. So now I need to buy inventory for $50,000, but I only have $20,000 in my pocket. I made $10,000 in profit. Like, I'm very profitable on paper, but cash wise, it sucks because I pulled out $10,000 from my pocket few months ago, and now I have to go find another 30,000, whether it's from my pocket or a bank or whatever. Like, it's hard.
Yeah, no, I was going to say, and especially for a new company or someone just trying it out, trying to get credit, or to try to go to a bank and borrow money, that you're just a brand new company. They're not going to loan you anything. So trying to find capital and stuff like that can be pretty challenging. A lot of the advice I give to those new sellers is grab a personal credit card. Just grab it and dedicate it to business and just start buying, especially, obviously if it's a smart move. But I mean, you've got to build up the credit to start financing that kind of inventory and stuff like that. But a lot of people come to me and are just like, I have a personal credit card, but it's not business, so I don't want to use it. Just use it. Just go. Don't slow down. Don't get in your own way. Just start buying it. Eventually you'll pay off that credit card and you're fine.
Nice. I love that. That's one thing that it's funny. I feel like good accountants always tell you, like, don't change your business, don't change your practices to optimize your bookkeeping and taxes. Like, do a good job, do good business, and then we'll kind of figure out the taxes later. There's some few things you got to tweak, like maybe set up an S corp instead of a C corp. These little little tweaks, whatever. Mm-hmm. But like, whenever I hear people say like, "Oh, it's okay," I lost $10,000. It's great because I now get to save $2,000 on my taxes. I'm like, but you lost $10,000, right. Or you burned it, right? Like, that sucks. You should be sad.
Yes.
And they're like, well, but I made $2,000 on taxes. Like, no, you didn't. You lost $8,000 net. That sucks.
And that conversation comes up so many times, Andrew, especially at the end of the year when somebody says, I have $100,000 of profit. Can I just buy a car and write it off so I don't have to pay $20,000 in tax? But you're buying a car, and let's say you don't need the car, but the car costs $50,000. You're spending $50,000 to save on 20. That means you're just losing another $30,000 on something you may not need. So it's funny that you say that things like that, because it comes up so often. Like, what if I just buy another computer or buy this? I'm like, but you're spending the money. You're spending X dollars only to save this. Don't do that unless you need it.
Yep, I love that. I have two more questions. I love those two tips there. So I'm gonna have to rethink about my inventory now. So that's good. That's good.
Yeah, listen, again, this is something that happened to one client. There are plenty of people that are calculating their inventory that way. Again, we want to make sure things are safe and that you're just doing what you're doing, so you just keep selling. It's just been our policy to make sure that it's nobody can question the way we're doing it, as in capitalize your inventory, expense it as you sell it. And especially if, let's say, you buy it in March and it's 5 months of inventory and you sell through it, doesn't matter how you record it. It all got sold, so you would have expensed it anyway. It's only really towards that end of the year time, if you, as you say, as you're looking to minimize tax so that you save money so you can reinvest in your business more.
The thing that made me sad, and this is I kind of, like, in theory I knew that this was going to happen, but when it actually happens to you, I'm like, this sucks. My first full year selling, so I kind of had a half, partial year, kind of growing, whatever, partial year, right. And then my first full 12 proper months. I started the year with $10,000 in inventory, and I finished the year with $70,000 in inventory. Our top line was, I don't know, $350,000, $400,000, something like that, right? So yeah, it was nice. I was like really happy. Like, I got, and again, this is all part time. I'm kind of like, I'm working as a full-time engineer or whatever, and then I get like this part-time income, and like I do the math. I'm like, oh my gosh, like, it sold $350,000, $400,000 worth of inventory or worth of sales, and on paper I made $80,000, right? And I'm like, wow, that's amazing. Like, that's close to my, it's whatever. It's in the same ballpark as my engineering salary. I'm like, wow, that's great. Okay, cool. But I made $80,000, but I only have $20,000 in cash because I have $60,000, $70,000 in inventory. And I'm like, I'm growing. I got it. I have more inventory, so I can sell more the next year. I got it. Okay, this is good. I'm fine. I got it. That makes sense to me, right? Then I went to the government and I said, hey, I had $20,000 in cash. But of course, the way the accountant made me tell the government, like, oh, well, but we profited 80, but I have $20,000 in cash. And the government said, oh, you profited 80? Congratulations. You owe us 30,000.
Right.
And I'm like, well, wait a minute. I only have 20,000 in cash. Oh, okay. Then it doesn't matter how much cash you have. You have to pay your taxes. I'm like, well, I made 80,000, but at the end of the year, in my pocket was negative $10,000, and that made me so sad. I'm like, why does this happen? I don't get it. I do get it, but also, like, I'm just mad about it, I guess.
No, yeah, and I get it, and it comes up a lot, especially with sellers when they say, "Oh, good, I just got my settlement from Amazon every 2 weeks, and I've got this money, and great, let's reinvest and stuff like that." But yet you're profit and loss statement is showing you're making money, make sure you save some money for taxes, especially if you really reinvest at the end of the year during the holiday time and you want to really replenish with your inventory and stuff like that. Hopefully that all sells out so that cash comes back to you January and February, because come April, it's tax time. We're going to have to pay tax on that. And just, I think this is a good point for some of those beginning sellers out there that, knowing your numbers is really important. Obviously, coming from an accountant, it's self-serving, but making sure you have accurate numbers of what your sales are, less your expenses, showing profit, so that nobody likes those surprises come April 15th. Nobody wants a call from me saying you owe $15,000 of tax, and they're like, I didn't even expect to owe any tax, because either they didn't think of it or didn't have the numbers correctly. It's just making sure you stay on top of your numbers and looking at your financials so that you're treating yourself like a business and aware of what kind of numbers you're producing. As like where you were just saying, you're an engineer and you're showing profit of 80,000. A lot of people just look at their top line number. They're like, all right, I'm working at this job over here, but I had $300,000 of sales. I don't need to work over here. Look at all these sales I have, but yet not going through, all right, I've got Amazon fees and all these other expenses. You may have a negative $20,000 loss or only a profit of $30,000, and yet you're quitting this $80,000, $60,000 your job thinking because you had so much sales. Making sure you look at your numbers, see what they're telling you, and making your business decisions off that.
The phrase I like from that is revenue is vanity, profit is sanity, and cash is king.
Cash is king. Oh, that's the best saying in the world. I tell everyone, cash is king. You can do anything you want if you've got cash.
Nice. Tell us, so Avask, I know, does bookkeeping and taxes and stuff like that. How do most e-commerce sellers, again, we're kind of thinking the $1 million or the $500,000 seller, that the annual revenue US based company, do you suggest they do like monthly bookkeeping or quarterly, or like how do you said know your numbers, but a lot, it's like, okay, how do I know them? You tell me, how do we know them?
Sure. So
how do we get to know them?
Yep. So what we do here, especially for our clients, is we give them monthly bookkeeping, a profit and loss statement and balance sheet. But I think the thing that talks to sellers the most is the profit and loss statement on a monthly basis. Knowing what kind of sales you've had, what kind of profit you're looking at, really gives them a good idea of how their business is doing. Because again, in their head, they could say, hey, I thought I had a tremendous month, but once you kind of look at it in paper, it really speaks to you on, I forgot maybe that marketing cost or all that travel I did to go to this event or that event that was very helpful, but just don't forget you've got those expenses. And so just seeing those numbers, even if you just eyeball them, okay, yep, I had a profit again this month, I had a profit again this month, kind of gives you a good idea. And then I think, especially for that $500,000 to $1 million seller, how can Avask really help them? First in the US is just bookkeeping, tax returning, tax planning for those who have to do estimate taxes and stuff like that, especially for the business that have profits. Just staying on top of that really gets you through the US tax side. But really what can, especially once you get up to that $1 million side, what can you do to keep increasing? To me, is expansion. Great, you're selling in the US, let's say you're selling Amazon.com and you've got $1 million in sales and things are going great. It's time to look outside the US, where again, Avask can help because we're all over. So you may say, all right, I want to sell in the UK or I want to sell in Europe, but I have no idea how to do that. I don't even know what the taxes are. I don't know what the rules. We've got our people there, and you're already using Avask in the US. We just hand you off to them to basically hold your hand and guide you through the expansion, saying, all right, here's the first thing you need to do. Here's how to get inventory over here. Here's the rules. Here's what taxes we can expect. Here's what taxes you're getting wrong. And don't worry, you don't have to worry about that. But getting you set up and getting you selling in more marketplaces is really, really the key. I mean, getting your product in front of as many eyes as possible, that's the way to get more sales. And so if you're really knocking it out of the park here in the US, and then expansion is really, I think, the next step for sellers like that.
Nice. I love that. That's fantastic. Well, Tim, this is the first part of our 2-part series, so we can end it here. And I have some cool stuff we're going to talk about in the next episode. We're going to talk about some more aggressive tax optimization things that I'm trying to do, and I'd like to see what you think about these things, and hopefully that's something that the rest of the audience can do as well. And we're also going to talk about when we have a windfall, when we do sell our business, what kind of things can we do or can't we do with that windfall money. That's going to be in part 2. So if you guys are new to the podcast, make sure that you subscribe to the channel. We're in all the podcast directories, and just go ahead and subscribe. We release episodes every single week. And if you want to hear the next part about advanced tax strategies and how to really optimize your taxes for that big exit that you have someday, make sure to subscribe and listen to the next episode. Tim, we'll be talking to you in the next episode, but why don't you give us a way that people can contact you or Avask or whatever to learn more about you and your services?
Sure. Andrew, thank you, first of all. And again, my name is Tim Nelson. I'm the CEO of Avask in the US, and I'm a CPA. And anyone can reach me at timothy.nelson@avastgroup.com or call our office here in New York at 914-664-1900.
Awesome. Thanks so much, Tim.
Thank you.
Hey guys, if you found value from this episode, I would love if you could tell the world. If you don't want to tell the entire world, I would love for you to tell iTunes at least. If you can go to iTunes, if you listen to this podcast on iTunes, go ahead and go leave us a review. I have a few here that are amazing that I love to read out. I read every single review that's posted. This one is a review from Amber K. If you're looking for a podcast to efficiently learn hacks to grow your Amazon business, this is it. Andrew's wealth of knowledge is abundant and generously shares it all for this podcast. The latest and greatest information to push to your business to the next level is right here. Stop reading this review and tap play. Nice. Oh, I love it, Amber K. Thank you so much for doing that. So if you think you have a review that is equal or better than Amber K's, or worse, whatever. If you don't like me, that's cool. You can tell me too, whatever. Go to iTunes, leave a review. Also, Spotify now is allowing ratings. So please go onto Spotify, and it's super easy. You don't even have to write anything. You just hit 5 stars and leave that review. You know, as an Amazon seller, how important reviews are to your business. I am asking you, at the goodness of your heart, please leave me a review as well. Thanks.